Here's the view from Barclays Investment Solutions, reducing their overweight in the United States equities and boosting the allocation to EM, writing that, quote, the divergence in the US and emerging market stocks seen so far this year looks overdone. Joining us from London, the man behind that note, William Hobbs, Barclays Smart Investor, Head of Investment Strategy. William, just get to the issues behind your big call right now.
Yeah, John, morning. I think the major thing to think about here is it's very hard for an economy as interlinked and important to the world economy as the US economy is to grow, to boom in isolation. And what you're talking about, I heard you talking earlier in the show, the US economy is ripping. And our belief is that strong demand, the US supply side, is really going to be unable to satisfy on its own. That means that a lot of that economic warmth is going to spread elsewhere, and that also probably suggests that the divergence you've seen so far in the US versus emerging capital markets is probably one that's gone a little bit too far, and we're trying to play the other way of it. Like I say, we've been long US equities all cycle. This has been one of the ones that we've really liked. It's done well for us, and we're still overweight just a little bit, but now our focus is really much more in emerging markets.
So William, I'm wondering why you don't just make a broader call from 35,000 feet to dial down risk, and the call you're actually maintaining is to maintain risk but look for a convergence trade. Why not just dial down risk completely?
Yeah, we don't think the cycle's over yet, and I think this is one of the things that, again, I heard you talking about on the show, and is one of the big discussion points about the bond market move recently, which is really, what does it mean? Is this telling us that, are we worried that the US is going to choke? But actually, if you look underneath the bonnet of that bond market move, it's not inflation expectations moving, it's not even term premium moving higher, it doesn't look like it. It's really the market raising its estimation of the choke point of interest rates in the US economy. R star has gone higher. So in a sense, the bond market is telling you there's more growth to come, and the yield curve is steepening again. The ISM is giving you the same message, both ISMs in fact. So really what we've got to make sure is that we're taking enough risk while the cycle continues. So we're not as risk on as we were, certainly not as we were 2 years ago, a year ago, but we still want to keep some skin in the game for what tends to be quite an important period to have enough risk in the end of the cycle.